Alright, today is Friday, August 7th, and this is a post-market review for the stock market activities today. We will discuss the closing of the market, the sector's performance, the futures performance, and we're going to look at the heat map and the headlines of the day, the technical analysis of the charts, and finally, we will conclude by reviewing the last bit of earnings that we had yesterday and today. The indices, look at that. Some of them managed to close in the green because of the last minute rally that we had before the closing. Of course, due to the low volume environment of the first half of August, the gambling and the Robinhood crowd dominating the market, and they're taking control of the market. They are programmed to buy no matter what. They're programmed to buy on autopilot, ask questions later. So, on the heels of the very good news of no deal on stimulus, we closed the Dow Industrial in the green by 46.5 points or 0.17%. The S&P 500 closing up 2.12 points or 0.06%. The good news of the no stimulus deal could not help the Nasdaq close in the green, and it closed in the red minus 97.09 points or a decline of 0.87%. Here is the sector's performance. Of course, utilities, industrials, real estate, and financials dominated the action today, while technology, consumer cyclicals, energy, and materials were lagging today. The futures performance, of course, reflecting the weakness in the materials sector in the S&P, and you see that metals are down today. Gold and silver are negative. Of course, we saw the dollar rallying a little bit, so that in combination of yields rallying as well pushed down precious metals just by a little bit. Platinum, palladium, copper took the majority of the blow. And of course, we talked about coffee yesterday, that coffee had a short-term top, and you see coffee trading in the red 2 days in a row. Lumber continues to march to the green, skies no stop in sight. Cocoa resuming its own rally. And of course, we're seeing somewhat of a bottoming process in the lean hogs futures, so we might see lean hogs rallying a little bit. Now, shifting to the heat map, you are looking right now at a heat map of the S&P 500. As you can see, tech lagged, specifically big tech, and of course energy and the China related names. If we looked at the full heat map, you would have seen Baba and JD and all the China related names being hit hard due of course to the executive decision last night to prohibit US companies from conducting business with TikTok and Tencent of China. Utilities and industrials specifically had a really good day. We saw also a rally in apparel. Certain investors and traders liked the jobs number, specifically the apparel numbers in the jobs report. We will talk about the jobs report in a little bit. And of course, banks rallying on the heels of the rally in yields today. However, the theme that we're starting to see here is winners versus losers. We're not seeing the tide that lifts all boats or sinks all boats happening like we've seen before in prior weeks. In prior weeks, we have seen the theme of momentum versus value, the stay-at-home versus reopening stocks, back and forth, back and forth. Now, if you dig in details, you will see that there are disparities and divergences within sectors. Case in point, look at the performance of AXP, American Express, which rallied today, versus the other credit card companies, Visa and MasterCard. Both of them lagged the market today. And of course, within big tech, Facebook rallied today, and the rest of big tech lagged. Microsoft, Apple, Google all lagged along with Amazon, of course. And when you dig deeper, you look at a category like resorts, for example, and you see Las Vegas Sands and Wynn Resorts are down, trading in the red, yet MGM trading in the green. Of course, there are explanations here. The gambling crowd were betting big on call options on MGM, so they probably had something to do with pushing the name a little higher compared to competitors today. But we also saw Penn National Gaming continuing the rally along with MGM, and you could make a conclusion here that investors are rewarding the names that are more involved into online gambling. MGM and Penn National are way ahead of Las Vegas Sands and Wynn in online gambling. Likewise, when you look at the cruises industry, we saw Royal Caribbean and Carnival closing in the green, yet Norwegian Cruises closed in the red. Norwegian continues to be the weakest name here, and this is of course a very interesting theme that we are seeing in the market. We have seen the theme developing last week, and now it's continuing and it's becoming more apparent, rewarding winners and punishing losers. And nothing, of course, illustrates that point more than the performances that we've seen today between Uber and Lyft. And the magnitude of the drop in Lyft was much higher than Uber. And the reason, of course, here, Uber has the Eats business, the food delivery business, and we saw that particular category thriving from their earnings report yesterday. We will talk about Uber's report in details at the end of the video, but the point here that Lyft does not have a food delivery business and it's being punished, and it will continue to get punished by investors who are interested in the ride sharing category because they will shift their money to Uber. Uber hedged their bets very, very well with the food delivery business and the acquisition of Postmates. And now, shifting to the headlines of the day, and of course, the most important headline of the day was the big jobs report from the Bureau of Labor Statistics. The report said that we have gained over 1.7 million jobs, and the unemployment rate remains at 10.2%. It got lowered to 10.2%. And of course, we had several indicators before the jobs report was released that we will see a negative trend here. For example, we figured out yesterday that we have seen an upward tick to the tune of 54% in job cuts in July. And of course, I showed you the headline yesterday in California of people reapplying for unemployment benefits for the second time because they lost their jobs again. Nevertheless, you have seen in the media and in many pundits and analysts' circles celebrating the jobs report as it quote-unquote better than expected. I don't know what is better than expected when you have over 10% unemployment rate and you are trending negative in terms of the jobs gains, which lead us to this chart that I released today. Looking at the numbers, you can see that the job gains from May to June, of course, we've increased job gains significantly. And the expectation, of course, was that this is a V-shaped recovery and the number this time around will be bigger than last month, and we will continue the positive trend month over month. Yet we have seen a decline here. We are trending negatively. Month over month, job gains declined by 62.5%. That pretty much destroys the whole narrative of the V-shaped recovery. There is no V-shaped recovery in sight, and this is the proof right in front of you. If there was any V-shaped recovery, we would have seen month over month job gains increasing more than 200%, and we continue the positive trend, or at least have a positive number month over month. We didn't have that. We actually deaccelerated and had a negative trend. There is nothing to celebrate in this jobs report. And of course, the second most important headline of the day happened overnight, where the Trump administration barred United States companies from conducting business with TikTok and WeChat, of course, a subsidiary of the Chinese giant Tencent. That, of course, scrambled the Asian markets overnight, and we saw the Chinese market closing in the red significantly. And I released this tweet overnight saying that Activision will get hit hard today because of its connections to Tencent. And of course, you saw what happened to Activision today, closing severely in the red. And as we get closer to the elections, of course, we will see more escalation of the narrative between the United States and China, and this cold tech war will continue to brew hotter. Nonetheless, of course, who did buy Activision Blizzard stock yesterday? It was, of course, the Robinhood crowd piling into Activision stock yesterday, and now today they're getting hit pretty hard. We've seen this theme from Robinhood gamblers and amateur traders making very bad bets. And of course, they assume that any name that drops heavily, it means that it will rebound heavily the next day and you should buy it. And you saw the action in Ultrix today. Ultrix was down more than 20%, yet the Robinhood crowd bought it today, anticipating a turnaround and a bounce soon. Sometimes that strategy works and sometimes it doesn't. There is a reason why stocks get downgraded and sold. The other piece of news, of course, we had is the Trump administration decision to tariff aluminum imports from Canada, 10%. Canada, of course, responded by slapping tariffs on our aluminum exports to Canada. Of course, this failed policy of tariffs been going on for over 3 years now, and it's been a complete failure. It failed to regain jobs in the steel and aluminum industry here in America, and it did, of course, it increased the cost for customers, increasing the prices for raw materials. And whatever jobs we gained in the steel and the aluminum businesses, we have lost in other industries such as the canning industry, in the beer businesses, and soft drinks factories. And what do you know? Fast forward, those aluminum jobs that we gained due to the tariffs in prior years, we lost them anyways after the COVID crisis hit. And in other news, of course, Indonesia is proposing additional VAT taxes on tech companies, specifically US and Chinese tech companies, TikTok, Facebook, Apple, Amazon, and the rest of them. As countries, of course, dip into economic recessions and they have their financials dwindling rapidly, they will resort to these kind of moves of shaking US tech giants for cash. And that is, of course, not going to be good for all these big tech companies. And now let's segue to the charts analysis. We're going to look at this SPY chart, the QQQ, the dollar index, and the chart of gold's futures. Starting with the SPY, the S&P 500, of course, opened in the red today, gapping down. And I released this tweet saying that expect these gamblers, these zombie traders who are programmed on autopilot to buy anything, any price, regardless of what's going on. They will push the market higher and buy the dips aggressively. And you have seen that action happen throughout the day. Every dip was bought, and at the end of the day, they managed, of course, to push the SPY to close in the green. This is, of course, a typical behavior of the combination of low volume in August and the surge of amateur traders in the market. These zombie traders, of course, they have no clue what they're doing. They're just programmed to buy. They wake up every morning, they get a list of tickers, they click buy, they press the button to buy calls or the stock, and that is it. They don't ask questions. And in many instances, they don't even know what they're buying. They don't know the names of the companies they're buying, what kind of business it is. It's just you get a list of tickers, you click buy, and that's it. No rationale whatsoever involved in their decision making. Case in point, I saw this options trade that opened for expiration in 2022 for Apple stock. The person is, of course, opening a trade for the 115 level in Apple. This is a call strike, by the way. I have tried to figure out what the rationale here of opening this trade. If you bought 115 strike price in Apple, first of all, it is very expensive and it will close in the money. So what is the point here of buying this call? And if we assume that the person conducting the option trade was selling these options, well, Apple was not going to collapse below 115 below 115 bucks. So these calls will be exercised and you will be obligated to deliver them. What is the rationale behind this trade? I don't know. Please let me know if you can figure it out. Type in the comment, what do you think the reason behind this trade? In my opinion, I think that this is a symptom of the moron gamblers who invaded the market. I think that this person is assuming after the stock split, if he buys the 115 strike price calls right now, when the stock split, he will have 3 more options for each option he or she purchased, meaning that they will quadruple their option positioning and these calls will appreciate significantly. Of course, after the split, option prices will get adjusted too. Your entry prices will get adjusted too. So your positions will remain exactly the same. This is of course similar to the morons who are saying buy Apple stock now because after the split you'll get 3 more for free. Another example for these the Robin Hoodiots, as I call them, instead of buying Tesla stock, they made the mistake of buying a ticker TLSA, Telsa, instead. And what do you know? They pushed the stock of this company to the stratosphere. And then after they realized their mistake, of course, they sold the stock. Some of them, of course, could not believe how cheap Tesla stock is, and they piled on it. And what do you know? It's the wrong ticker. It's the wrong company. But this is the environment of the stock market right now. Let's take a look now at the weekly close of the SPY. When you look at the weekly close, we closed above the gap from February of 2020. That is very positive for the SPY, at least when you look at it with no other annotations. You could argue, of course, this was a low volume week, etc., but you gotta give credit where credit is. The chart, looking at it as is right now, from a weekly perspective, closing in the green, above the gap, that is a bullish positive behavior. What about the Qs? The Qs is a different story here because when you look at the daily chart, it is still bullish. The trend is still intact. We're well above the downtrending bear channel. I even removed it from the chart because it's gone. We're trading well above it. However, when you switch to the weekly chart, you see that we are starting to make a topping look in the candle here. So perhaps we are seeing, specifically when you combine the action in the heat map with the action in the chart, we will see, of course, if this trend continues next week. Now, let's look at the dollar index chart because the dollar rallied a little bit today, but as you can see from the chart, it is just consolidating after a big drop. The bulls will look at it as a bottoming process, finding its footing, and it will rally from here. The bears, of course, this is just from a technical perspective alone. No other factors involved. Say that this is a bear channel. We're broke down. We're consolidating. We're going to trend a little bit higher. And then the primary move will continue into the red territory. Of course, when you look at the facts, the yields and the commitment from the Fed to increase inflation and lower the yields, that is very negative news for the dollar, and we expect the dollar to trend lower. The Fed, of course, trying to have their cake and eat it too. They want lower rates, but they also want to keep the price of the US dollar stable by conducting all these swap facilities with other central banks. That would have a temporary effect of holding the dollar steady, but in the long term, it will contribute to its demise. What about gold? Gold is taking a break from the massive rally it had before, and you can see from the daily chart and in the weekly chart as well, it is reaching an exhaustion level in the RSI, aka overbought territory. In case, of course, gold takes a break and trends lower in the next few days and next few weeks, the support here is at 1926. I expect gold to bounce from that level if we reach it. Alright, let's conclude this video by looking at the earnings that we had after the bell yesterday, and the most important names, of course, are T-Mobile and Uber. T-Mobile, of course, reported impressive earnings and it rallied significantly today. I told you in my earnings preview video that T-Mobile, unlike AT&T and Verizon, is specifically concentrated in the telecom business, and they're not involved in any internet or cable providing when we see, of course, the cord cutting on those businesses, specifically contributing to AT&T and Verizon's earnings being under pressure. T-Mobile is increasing their share in the market, of course, beating AT&T and becoming the second largest US telecom provider, and they're, of course, eyeing Verizon at number 1. T-Mobile's services are very good. They've increased the quality of their services, their customer service, and the reception. Of course, they're building more towers, they're leasing more towers, and the prices are very, very good compared to Verizon and AT&T. I'm a T-Mobile customer, and I'm very satisfied. I will never switch to Verizon or AT&T. I had very horrible experiences with both. What about Uber? Uber, of course, closed in the red today, but remember that the stock rallied throughout the week. In my earnings preview video, I told you that the most important thing here is we need to see the growth year over year for the rides category and for the eats category. Any decline in the rides category should be substituted and compensated for by increases in the eats category year over year. Here is the chart from last quarter, the first quarter, and you can see that the rides business increased 2% year over year and the eats business increased 53% year over year. Fast forward to this quarter, of course, in the heart of the crisis, the ride business collapsed to 61% year over year, negative growth, of course. However, the eats/the food delivery business increased by 103%. So whatever slowing in growth that Uber experienced in the rides category, they made up for by growth in the eats category. And this is why I think that Uber bottomed and it will trade positively in the next coming weeks. Unlike Lyft, of course, because of course Lyft is limited to the rides category. I of course opened an options trade on Uber in the beginning of the week, and I of course released the trade on Twitter. As you can see, it was a call spread. The shorter leg expired this week and the longer leg will expire during the week of August 21st. This is of course for the strike price of $33. All in all, the entry price was 45 cents. And today, because of the action in Uber was down over 6%. So the shorter leg expired worthless. The stock closed a hair below 33, which is exactly what you want to see from this trade. And now the longer leg, the $33 expiring during the week of August 21st, is worth over $1 per option, which makes this trade, as is right now, up over 100%. It already doubled without doing anything. And if Uber continues to appreciate in the coming 2 weeks, this could turn to be a really profitable trade because the entry cost was really low. And you could, of course, double, triple, or even quadruple your investment from this trade. Finally, before I log off, we had, of course, the circus in DC with the stimulus. We had a no deal for now, but we will see if they will go back and find a compromise where they can come out with a deal. Either way, if this thing prolongs, because the stock market is trading almost at all-time high, there is no motivation from either party to get to the table or come up with a deal. You could see in the next week, if this situation prolongs and we don't have a deal over the weekend, the stock market, of course, will throw a fit and will sell off to motivate the politicians to come out with a deal. This is typical behavior. We have seen it before during government shutdowns, and we have seen it before during the 2008 negotiations of the bailout and the TARP deal. So be prepared for that kind of action to repeat itself again next week if we don't have a stimulus deal by this weekend. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.